can the investors in the room expect to see from the merger with Standard Life?
Well, we really did it to get tickets for the British Lions tour.
We sensed that was behind it.
Or to sponsor Andy Murray, so we've succeeded. We were both pretty good asset managers in our own right and had no need to do anything. But we really felt that coming together, it would give us a much broader product suite or offering for clients. And part of the problem was we were both sort of wrongly known for just being sort of one-trick ponies. Standard Life for GARS, us for emerging markets. And this gives us the opportunity, I think, to create a world-class investment company that's capable of competing against the big American houses. And even after this, when we'll be number one in the UK, number one in Europe by revenues, we'll still only be about number 18 or 19 in the world. So you can see there's still a long way to go. And people say, is scale important? Yeah, scale is very important in our business. You either want to be big or small. Where you don't want to be is in that sort of middle ground, and perhaps both of us were at that sort of bottom end of the Premier League, and hopefully this takes us slightly further up that league table.
Well, as a West Ham fan, I'm used to being at the bottom end of the Premier League, so it feels familiar. But that comment about having to be either big or small, does that mean that you can foresee more mergers in a similar space from other asset managers?
Yeah, I think so. I mean, especially in the US, we're seeing a lot of really the war, and this is not a passive versus active move to defend against passive. But in the US, especially in US large cap, that's where we're really seeing the battleground of passive. And if you ask a US fund management CEO how he's feeling at the moment, his morale is rock bottom while the stock market's at an all-time high. So there's something disconnected, and they're definitely getting hurt by BlackRock and Vanguard. BlackRock referred to Vanguard as socialists, by the way. So there you go. That's. They don't have to earn any money, they don't have to make a profit. So it's definitely there. And also we want to have the full range of products we can compete with in the US. And our intention is not to compete in US large cap, but we'd like to take our products to the US and obviously to Asia and Europe. But US still has half the world's assets under management.
And thinking about the bigger strategic picture and some of the things we were hearing from Ed Balls earlier about developments in the world at the moment, what are the kind of issues that concern you or excite you in your business?
Well, I think there's obviously huge geopolitical risk out there in Europe at the moment with these elections coming up as far as the Eurozone is concerned. And then last year we obviously saw these two massive decisions, Brexit and Trump, which signaled just the huge unrest that globalization and immigration have caused to the average worker in the UK or the US. I'm actually probably more positive on both of them than most, maybe because asset managers are not hugely affected. But going back to America, I actually think Trump will spend on infrastructure, defense, and I think we'll see some pretty good growth there. And if we see growth in America, the rest of the world usually benefits. And I'm not convinced he can be a protectionist president. I just don't think he has the ability to stop these imports coming in if America grows.
Mm-hmm. And you know Donald a little bit. You played golf with him, I think.
Played golf. Yeah, he's a good golfer, by the way. So, but I think what we've got to remember about Donald Trump, which is a really interesting thing, all he's ever run is a family office. So, he's never run a big company, a big corporation, or a government. So he's very hands-on and makes instant decisions, as we can see. I spoke to him after he got elected, and he said that he only spent $200 million to get elected, whereas Hillary Clinton spent $2 billion. And he uses social media, as you can see, pretty well. And I think he's also chosen some really good people round about him. Gary Cohen of Goldman Sachs, who I know very well. Yeah, he's really smart. Rex Tillerson is smart. So he's chosen some good people, I think, in his government. It's whether he can leave them alone or not is going to be the issue, whether he's going to interfere, But I don't think it'll be as bad as we all think. I rather hope it isn't. But,
I think we'll all share that view. and a little bit closer to home, Brexit, what do you think might be the implications for your operation in particular?
Well, asset managers big asset managers are largely unaffected because, again, scale helps here, and we all had our operations in Luxembourg. So really the way the large asset managers organized themselves was they had funds in the UK and funds in Luxembourg. They sold the Luxembourg funds into Europe and the UK funds into the UK. Now, our thinking is we will not be allowed to passport funds across into Europe, and Europe will not be able to passport funds into the UK. So you could argue, actually, it's more inconvenient for the big European fund managers who don't have the UK ranges at the moment. But the risk, which I think is small, is that we're not allowed to manage the funds in the UK. And that's a different regime. That's equivalence, as you know, equivalence of regulation. And as long as we're allowed to manage the money here, we're okay, because it's where the fund managers are really that matters, not where the funds are. Banks have got a slightly tougher. They definitely, wholesale banking is really where the issues are, and if you listen to my very good friend Douglas Flint, the chairman of HSBC, you can really depress yourself about Brexit, and it's tough for them because they are going to have to use subsidiaries in Dublin or places like that. They've got to plan for the worst and hope for the best, basically, and it's going to be a tough 2 years. What we absolutely need are transition arrangements after the 2 years. So we need the 2-year negotiation and then an either 2 or 3 year transition period, and also grandfathering in contracts. So if you're doing a swap now, a 5-year swap, those swaps are grandfathered in at the end of the 2 years. So I don't think it's going to be as bad as we all think it is.
Yeah, certainly that transitional period at the end of the 2 years is number one on our wish list as well. Feels
number one.
hugely important.
Look, Douglas Flint and I were in seeing Theresa May with Jez Seeley of Barclays and the CEO of Schroders. And she's got it. She knows exactly what she needs to do on transition. She's also absolutely got it on EU nationals in the UK. There is no problem as far as she just doesn't want to concede that until we get reciprocal rights of UK citizens in Europe. Yeah. And I think she's quite right. So she knows exactly what she has to do, basically.
Okay, let's open up to questions from the floor now. There's one just behind you there, James.
Yes, hello. You started out as an investment trust back in 1982, and so I know it's something you understand well. And I think you might agree it's a good option for the self-investor, and one of the reasons is they have an independent board that can hold the manager to account and agitate for lower fees, etc. What do you think of something like this becoming available for open-ended funds?
I think it's inevitable that's going to happen. We already have it in the US, and we have it in Luxembourg. It's just the UK we don't have it. So I think it's part of the FCA review. I really hope we go for the single fee, independent board, complete transparency as well, because we've got to win back the trust of investors, and I'm totally in favour of an independent board. As I say, look, we're used to it in the US. The only problem in the US is you've got the lawyer there as well. In fact, you've got 2 lawyers in the board meeting alongside the independent directors have their own lawyer, and we have our lawyer. So hopefully we don't get to that stage of corporate governance.
A couple more questions on the aisle there.
Martin, can you say a little bit about the possibility of another Scottish referendum and what you think might happen?
Look, I know Nicola Sturgeon pretty well, and she's a pretty cautious leader. I'm not convinced she'll go for a referendum unless she's pretty sure she's going to win it. And I think, and I don't know, but my instinct is she would wait until after the 2-year negotiation has taken place to see what the result of the Brexit negotiations are. But look, we're based in 50 countries around the world, so and headquartered here in Scotland. So we can deal with whatever situation comes up, including if independence occurred. It's not as if we're a bank, needing to be bailed out by a government or something like that. But no, we're very relaxed, whatever the outcome, and apolitical on this as well, just for the record, by the way.
And another question just in front, Jenna.
He was going to ask the same question.
Oh, okay. Then, Jenna, there's one just to your right in that case, lady 2 in.
Hi, Emma Cusworth, theresponsiblecapitalist.com. It's International Women's Day, and yet this is an industry where women have found it particularly difficult to make progress. What do you think needs to change in the fund management industry for women to begin to really make a meaningful change in the amount of assets that they manage?
Yeah, I really don't understand why it isn't an industry that women aren't attracted to, and we see it because the way we run our money in teams and recruit graduates to run our money, it really has to start at the graduate level, and we try and do 50-50 on that 50%. But on the applications, it's still about 70-30, 70% male, 30% women. So we've got to get more women to apply. And then we need to get more women into the executive committees as well. The boards are fine, oddly enough. I mean, there seems a lot of capable women who can go on PLC boards and that sort of thing. It's really at that executive level that we're still struggling. And we've got to get away from just being the head of HR or something like that on the executive committee. We've really got to broaden it. We are really trying very hard on that to move women up the management ladder, really. And I'm not speaking about just managing the money. I'm speaking about actually managing the company as well, which is another. My own personal pet subject on this, which I don't understand, is more than 50% of the accountancy profession are when they come in, are women, and yet we don't see them at the finance director level of PLCs, and about 50% of CEOs come from the CFO. So I think accountancy as well. I am an accountant, of course, as you can tell, so that's why I'm pushing this. I think accountancy is a big route as well. We should be pursuing.
I was going to ask you about that whole issue, actually, Martin, because I know you launched a returners initiative recently, which tried to get people coming back from career breaks into more senior roles. Obviously likely to be more women than men at the moment, at least. But why did you do that, and how's it gone?
It's gone it's gone really well, actually. I'm really impressed with how many people have applied, including men, by the way. So I'm really, really impressed, and the caliber, and we're definitely going to take on 5 or 6 who wouldn't have who wouldn't have come back into a career. So it's a fantastic initiative if we can make a success of it across the industry. Same with apprenticeships as well in the fund management industry. That's been fantastic as well. And the 2020 that the CEO of Henderson's has started, taking people from the more unfashionable universities and bringing them in, that's worked really well as well. So we're really trying to diversify the workforce, our talent base. But it's hard work, you know, and you've got to do it. There's a guy I got to come in and speak to us, and I recommend it for anyone, called Martin Donnelly, and he's the permanent secretary at the Department for Trade and Industry, or whatever it's called now. And this guy, he has achieved 50-50 parity in a government department of the top 100 people. And he said he did it by saying, you know, it's okay that you have to go home at 4 o'clock today, or it's okay to job share. And it's these sort of things we've got to introduce into our industry as well.
Thank you. I think there was another question somewhere in the middle ranks there. Oh, there's one down near the front here, Jenna, actually. Still waiting for my first question online, so those of you watching the live web stream...
I'm not sure you can use the app myself, but that's...
Please do feel free to ask questions.
You pointed out that there's much more to Aberdeen than emerging markets, but could you share with us your views on emerging markets, which have been out of fashion for rather a long time?
4 years, it's been 4 years. And if you read any press, they'll point out to you that we've had 15 quarters of outflows, which coincide exactly with the peak of emerging markets in March 2013. Then in the third quarter of last year, it looked great. Money started coming back in, and then we got the unexpected US election result, and that stopped the flows in their tracks. I think this year we'll start to see some flows back in. I mean, you've got to be very selective in emerging markets. So, you know, our preference is definitely India, Southeast Asia, China. We still have problems with corporate governance of the companies. Good growth, but finding companies to invest in. But the great thing about emerging markets is they don't really lend themselves to passive as much as, say, US large cap does, because they're so inefficient. You can invest across the world, avoid Russia if you want, or whatever. So, no, I'm hopeful they're on the way back. I keep touching wood every day, you know, just to see.
Question down the front there. Thanks, Jay.
Hi, Martin. We've touched on this, but I mean, I'm just interested in the public perception of the industry. And do you think there's a problem there? Do you think the industry should be doing more, and what can it be doing if you think it should be doing more?
Yeah, there is a problem. I mean, you know, there was a study that we came below investment bankers, which rather surprised the industry, because, you know, the asset management industry think that we all think we're sort of class above the investment banker, but to come below them was a bitter blow. I really think that's why this FCA review is good news, because I think it's going to force us to do the things we should have done before. So complete transparency on pricing. I'm speaking about funds here rather than obviously managing money for pension funds, but it's got to be a single price. It's got to include all the admin. It's got to include things like perhaps dealing costs. It's that sort of thing. We've got to become more transparent and more long-term, I think, as well. And you know, I'm a great believer in long-term investing and allowing companies to invest for the long term. Because in the US, as you know, the main reason the market keeps going up is they do buybacks. There's more buybacks than every quarter. They just return cash to shareholders, and we'd rather see them investing that money. But I agree with you. We've got a real perception problem, and we do need to tackle it.
One right at the back there.
Hi there. It's Liz O'Leary from Reuters. I'm just wondering if what you make of the scepticism about sharing the CEO role. Can you give us any detail on how it might work? Thanks.
It's great. I love coming to these conferences.
You never know what you're going to get asked, do you, Martin?
So, yeah, I mean, I think, look, what I would say in the financial services industry, co-CEOs, co-heads are very common, especially across investment banking. Now, I think Keith and I are pretty different sort of characters, and we genuinely believe we've got complementary strengths. And also, there's a lot to do. We have clients in 80 countries now around the world. I'm on the IIF board. I'm on the MAS International Advisory Panel. So we've got complementary strengths, and I'm actually very, very positive that this will work. I actually got an email from the co-head of investment banking at UBS saying that he'd had this great relationship with his co-head for many, many years, and he was going to send me a document on how it should be done. So I'm waiting that with interest.
It's a question in the middle there, John.
Thank you. John Dembitz. You mentioned China and corporate governance being a concern. To what extent do you feel you should be using your power as an investor on corporate governance issues within the UK?
It should be at the heart of how we invest. And so the first thing we had to do was get our own remuneration structure through. So we managed to get 98%. So that gave us a good platform to be able to take the moral high ground on this, and we intend to be pretty firm with companies on things like remuneration, corporate governance, all of these things, and we regularly vote against. In emerging markets, obviously corporate governance lags a bit behind, and really, emerging markets, often it's about, can I trust the family I'm investing alongside? And it's that sort of thing. India's got great, very good corporate governance. Oddly enough, it's probably a legacy from the UK's time there. So, but it should be at the heart of what we do. We place our corporate governance guys alongside the investment team. They're not separate from the investment team. And I'm not sure I agree with the model of having them separate. I think they should be sitting alongside the investors, and so that they're making the decisions jointly rather than separately.
Martin, Edward Boncarter, Jupiter.
As you know, Martin,
I'm biased as a smaller asset manager. So I'm interested in your comments about scale, and I accept your point that there are probably scale benefits in a big merger that you're proposing for distribution, maybe administration. But as far as I can see, there's little relationship between the size of an asset management company and the outperformance the client receives, either a unit trust investor or a big pension fund. Would you like to comment on that? In fact, I'd argue there's diseconomies of scale, but you could say that I'm biased.
You've got a very fine company. I notice you're now on the next list to be taken over, so... Look, I agree. As you know, I agree with everything you say. I think, I've always thought Jupiter's a very good company. It focuses on what it does best, which is largely managing money for the retail investor in the UK and so on. And absolutely, I would class you at the top. This sounds rude. The top end of small. Sorry, but. I think I'm getting myself into a real hole here, aren't I? I'm not really. At the top end of that sort of scale where you've got the benefits of being one office, it's compared to our 50 offices around the world, that's really where you need scale. If you're going to have 50 offices and manage money in Singapore, Thailand, Hong Kong, Malaysia, you do need scale for that. But if I had my time again, I'd be a hedge fund manager in London. I mean, it's a great life. You know? West End, go shopping, it's great. So
you don't get these benefits in Aberdeen. Question down the front there.
Martin Grenville Johnson, fellow accountant.
Yes.
Aberdeen and oil and gas. Have you got a sort of view on where we're going with that now? Because it seems to be very tough up there. And if I may say so, you've been sort of, you've promoted Aberdeen massively in your time. And Aberdeen must be sort of slightly worried about where this amalgamation sort of takes you in all of that. So first of all, oil and gas, and secondly, Aberdeen.
Yeah, I mean, taking the second question first, obviously the name will be a combination of Aberdeen and Standard Life, so I don't think there'll be any change there. But on oil and gas, yeah, no, it's look, Aberdeen is tough at the moment. I mean, I do think the oil price is going back up because investment has just stopped globally in oil in production. So, and it'll turn very quickly when it does turn. That's the oil price. Whether Aberdeen ever recovers or not is a different matter. Now it's a high cost, as you know, high cost oil producer. But against that, I would say only 2 of the top 10 oil producers in the world are democracies. So do you want all your production in a non-democracy? So I think there's a place for that. And then there's the job of disassembling the 1,000 rigs that are out there. So, I mean, that's going to be a massive job for someone. I mean, it's going to take years and years to do that.
Martin, I'm conscious of your time. You need to leave in about 5 more minutes, so probably have time for 1 or 2 more questions. But before I do, I just want to ask you a little bit more about the FCA's market study. You mentioned it earlier in very positive terms. What sort of changes to the industry do you think we might see as a result of it?
I just think, as I said earlier, we've got to change as an industry, as we were talking about, to regain the confidence of investors. And inevitably, the fees are going to come down. Again, that's putting pressure on asset managers. So they're facing headwinds really all over the world, I mean, or all over the place. We've got lower fees, we've got higher regulatory costs, paying for our own research in future, which I think inevitably will come. And we've announced we're going to pay for our own research rather than use commission. And that was because the FCA said to me, I always remember, I thought, they said, you are using clients' money to pay for your research. And I took the view at that point it was only going to go one way, and we may as well bite the bullet on that. So all of these things they're good for the consumer, actually, and that's what I welcome. I think if we can do a good job for the consumer, it's good for the industry.
Do you see any risks, any potential downsides?
No, I don't think so. I mean, I think everything they've said, including the question about whether they should have independent boards, all of these things are good. And you know, it's better not to resist what the regulator tells you to do, which is always a good. It's best just to do it and adapt, and that's my view.
I can see the pensions regulator over there nodding furiously at that comment,
yeah,
Martin.
Well, yeah. See, I'm the good fund manager. Yeah.
And time for one final question over there.
Hi, Sue Rust from IPE. You said you want, or that you have to become more long-term. That's something that we hear a lot about, long-term investors being long-term. How do you plan to do that? And do you feel that there are any barriers to actually being able to genuinely be long-term? So pressures to actually be short-term.
Well, I've got a good story which I will relate. I shouldn't really, but I will. Which is I'm on a advisory board with Paul Pullman of Unilever. You see, so he's obviously been in the news recently, as I'm sure you all know. So he is a great advocate of long-term, as you know, every speech he gives and so on. And I said to him, Paul, the only problem is your own pension fund is not long-term. And he came back to me about 6 weeks later, and he said, do you know, you were right. I went and checked up on the Unilever pension fund, and he said, they were full of investments or whatever it is. And he said, so it's got to be, it's a circular business, this. We invest in the companies who have their pension funds, and then we might manage some of those pension funds. So it has to be that sort of circular. But again, we've got to get away from just quarterly reporting for companies. And I'm a real firm advocate of that.
Thank you, Martin. I appreciate you have to head back to London now. It's been a real pleasure talking to you this afternoon and discussing some of these big issues with you. I'm sure everyone in the audience would, like to thank you for joining us.
Thank you very much. It's good fun.
Thank you, Martin.